from this calculation, you can see that from rent or from rental property, someone gets 750 million. That is at the end of 10 years. Okay. And then from bonds, someone gets 882. Okay. Assessment of after 10 years, your bonds are done and you're left at zero. So for the personal rentals, you have a property that is a piece of land that has probably grown from 100 million and is probably now at the value of, because 10 years, I mean, the place has grown really big. The town has developed, and the land that was at 100 million can even shoot up to 200 million. And besides the value of the land, you have an apartment, a block of apartments, which you built for around 600 million. What's going on, guys? Welcome back to your favorite construction channel. Yes, if you are looking forward to information that has to do with real estate, that has to do with entrepreneurship, that has to do with design, that has to do with architecture and all that, we discuss all those things on this channel. So if you're on this channel and you're interested in that kind of content, you are actually in the right place. Okay. So there has been a lot of discussion going on around whether someone should invest in treasury bills or treasury bonds or investing in real estate. Okay. So I believe in this video I'm going to give my unbiased opinion. Well, it might be biased, but I hope it won't be biased that much. Okay. Because there has been a lot of discussions going about those two topics, and people are thinking which one is actually more profitable. Okay, for those of you who do not know, treasury bills and bonds basically lending money to the government. Okay, so you can do that directly by lending money to the government through Bank of Uganda, or you can do it through the secondary channels, that is using unit trusts or insurance companies, or investing through other banks that hold all this money together and then invest it in Bank of Uganda for a higher interest. Okay, usually the interest for Bank of Uganda, they can range between 12 to 15%. That is for bonds. That is if you're investing for over a long period of time. Of course, these bonds actually benefit you more if you're putting large sums of money and you're fixing it for a longer period of time. If you choose to invest in treasury bills, that's like over 3 months or 6 months or just 1 year, the margins are really, really very low. The interest that they give you is actually very low as 4%, 3%, which at the end of the day, if you're investing little money, it might not make a lot of sense. Okay. But in this sense, we are going to look at the most conservative one, which is actually investing in treasury bonds, and we are going to look at for a period of over 10 years. We are going to actually look at exactly 10 years. So we are going to discuss how that money actually accumulates, because this money is paid to you every year, but in only 2 installments. That means every year you are paid twice. That means after every 6 months. Okay. And then on the other side, if you're investing in rentals, of course, you keep getting your money monthly. But to have uniformity in our discussion, we are going to make it per year or even per month, because even if you get it per year, we can distribute it over, or we can populate it over a month and calculate how much money you actually get per month. Then looking on the side of rentals, because for bonds, it's a bit of a secure investment. You don't have to worry that tenants will not come. You do not have to worry that my business will make a loss or anything. I mean, the percentage or the interest that they give you is actually fixed. It will not change as long as you are still within that time frame. Okay. So, and on the other side of rentals, which in the real sense is actually a bit of more risky. Some months you might not have tenants, but we are going to rule that out, because in the scenario you're actually going to consider is that you are looking in a place where there is already demand for rentals. Okay. And in this scenario, you're going to be discussing a case. We are going to be using practical examples, and we're going to be making actually calculations on paper you'll be seeing on the screen, so that at the end of the day, you can be able to gauge from those calculations which one is actually more profitable. And I want you to watch this video to the end, because at the end is where the catch is, because most of the cases we are looking at only 10 years. But when you look beyond 10 years, you realize that the tables actually shift. Okay. So I want you to pay attention, and also pay attention till the end, and make sure you actually get where the catch is. Okay. Because I mean, there is this sector that is pushing this, and there's this sector that is pushing the other. So at the end of the day, everyone is going to push what puts them in a better position. Okay. If it's banks and unit trusts and insurance companies and all that pushing this, of course, you as a lay person, it's important for you to do your math as a person and know your investment goals, whether you're looking at 10 years or you're looking at more than 10 years, or you're looking at 20 years, 50 years, 60 years, or even building generational wealth. Because when you look at real estate, and you want to invest in real estate and get your money back in just about 2 years, 5 years, 4 years, 7 years, that doesn't make sense, because real estate is more of a security than actually an investment. Okay, actually that's why it's called real estate, because it's something you can even pass on to generations. Okay, because for others you're only looking at 10 years, looking at 20 years, but real estate you're looking at for a lifetime. That's why even when we are building structures, you're building to have a life expectancy, or the life of the building, the useful life of a building should be about 100 years, 150 years, which is enough to say that it can actually be 2 generations. Okay, so I want us to discuss this in detail. We're going to discuss all the risks involved, and at the end of the discussion, or at the end of the calculations, I believe you'll have enough information that you need concerning this topic. So if it involves a bit of math, just bear with the math. I believe we will try to make it as simple as possible and quick as possible, so that we don't make the video very long. Okay, so get yourself a cup of coffee, stay glued to your screen, and make sure you watch every detail in this video. So now, starting on that, we look at we are going to start with treasury bonds, because we've established already that bonds are more profitable than bills. Okay, so with the simple formula that is well known to every financial advisor, everyone, is available on the internet. If you invested a case of 700 million is what we are looking at to invest it in actually in treasury bonds. So the calculation is going to be that the money you get every month over the period of 10 years is the 700 million that you've invested multiplied by the percentage, which we have established that to be conservative should be 14%. It's one of the highest percentages that surely has been. I've seen 15% before, but usually it ranges between 12 to 14%. Okay, but when you get from the secondary market, that is like banks and trusts and maybe insurance companies, you realize that the interest rates are much lower. They are much lower than actually 14%. So 14% is actually a conservative figure. Then we take 0.9. This 0.9 I'm putting is because the treasury bills are actually taxed at 90%. Okay, sorry, at 10%. So when they are taxed at 10%, that means after they've taken away the tax, which is with an even a withholding tax, which means the tax is removed before you actually even paid the money. So you remain with 90% of your money, which is 0.9. Okay, so then we divide by the 12 months. Okay, which is going to give us 7.35 million. This is the money you get actually per month on a monthly basis, but of course it's paid to you every 6 months. Okay, but if we populate it or divide it over the 6 months, we get that we get 7.35 million per month. So if you're to multiply by 12 months in a year, then times 10 years, you will get over the 10-year period, you will get that you pay 882 million. Okay, so for treasury bills, you can see that this is really, if you compare these two, you find that there's a bit of a difference. Okay, that means you've made over a profit of 182 million over a period of 10 years, risk-free. There's no hassle, there's no struggling, there's no questioning, there's no, basically 182 million, which I think is a good margin. Okay, so this was basically for the bonds. Okay, now when we go to the rentals, I want us to pay very good attention, because rentals might involve a bit of more math than the treasury bonds. Okay, so I want to split these into two, because the rent that we get in it's established that rental income, or the rent of properties actually increases by 12% every 5 years. So let's say, for example, if you're staying in a place and you are paying 800,000, chances are high that 5 years from now you'll be paying 900,000. I think those of you who stay around can really agree with me. For an area that we are considering in this scenario, that should be possible. Remember, we are looking at an investment of 700 million. So for you to make the most out of this, you need to find a place where the rent is readily available. Okay, that means if you're investing in a place and you buy a 50 by 100 plot, for example, and you establish your rentals, okay, and maybe this one can hold about about 3 apartments or single bedroom, and you can still have parking of about 7 cars. Okay, so for a scenario like that, let me just illustrate from here. For a scenario like that where you're having 3 units of single bedroom, okay, with parking, and the place it should be located in an area where rent is readily available. I mean, you don't have to wait for 3 years or 4 years or even 2 years for tenants to actually move in. Okay, so land in such an area should cost you about 100 million of this size, or even 80 million. So areas like this can be maybe Buwate. You could look at areas like Kungu, which is just next to Chanja, or you can look at areas like Kasangati. You can look at areas like Chira, where land should be in this range, and also you can have rent. I mean, when you build such an apartment, you know people will actually occupy that apartment immediately, even while you're still building. Okay, so I'm just going to rub that because that was for purposes of illustration. Okay, so heading back to our calculation, with all that being said, in the first 5 years, this is the next 5 years. So in this first 5 years, the rent is going to be 800,000 for a single bedroom house in a place where you have bought at 100 million. You can't fail to have tenants that are willing to pay you 800,000 per month. Okay. Now this is also something else to note. When you have rentals that are bungalow and rentals that are storied, for some reason that is not very clear to me, you realize that tenants are willing to pay more for storied apartments than bungalows. I mean, if you find in a place where there are rentals, single bedroom rentals of bungalows, that people are paying for 600,000, you'll find that people are actually willing to pay 800,000 for a rental that is on a storied property. In even some areas, it can even go up to 1 million. Okay, I don't know whether it's because of perceived value or perceived security or perceived image. I really can't tell, but if you've been on ground, you can actually see that that is so true. Okay, so considering that, and we consider that for the 9 apartments, yeah, we can create we are going to make a separate video where we can break down all these costs of the apartments and all that, how actually 600 million or rather 620 million can build for you the 9 apartments. Okay, remember the 80 million was used to buy the land. 80 or 100, these two can interswitch. You can always balance between the two and get at least the 9 units out of this 700 million. Okay, so of course, finished well and all that. So for the 9 apartments multiplied by the 12 months, okay, at the end of the year, you should be getting about 86.4 million. Okay, then after the 5 years, the still same 9 apartments being charged at 900,000 times 12 should be getting you about 97.2 million. Okay, so we are comparing them side by side because they give different answers. So this is the money, this is the rental income that you get at the end of the year before tax, because rental income is also taxed, though it is taxed differently from other incomes, because the rental income tax is a bit lower than other incomes, which are usually 30%, and then for employment income it's a bit progressive depending on how much you earn, which is called payee locally. In this scenario, when we include the taxes that are involved, we'll get the 86.4 million. Remember, any rental income that generates a total rental revenue of more than 2,820,000, that's 2.82 million, is actually taxed. Okay, so if you're having any rental income that generates more than that, the excess beyond that 2.8 million is actually taxed at 12%. Okay, so when they tax the 12%, that means you remain with 88%. I'm trying to make it quicker, but I believe you can understand that. So 88% is the 0.88. So after tax, that means you remain with 73.555 million. Okay, that's actually the amount of money that you are getting after tax. Okay, so looking at all that, of course, we'll consider that maybe you have a security guard, okay, who you pay 200,000, because I mean people who are paying 800,000 will not live in a place where there's no security, where there's no security guard. So you pay a security guard 200k times 12 months. Okay, that means you'll be paying them 1.44 million. So I want us also to include repair costs in our calculation. But I think it will not make sense to include these repair costs, because usually for apartments of this class, there's always what they call a security deposit, which for this case is 800,000. That means every tenant that actually comes into your apartments pays an extra month that is worth the value of the monthly rent, that is going to be used to repair any damages that the tenant has actually caused to the apartment. I think most of you understand that, okay? But that is very tricky if you're dealing with the lower versions of rentals, where people are paying 200,000 or 150,000. Usually those tenants can be stubborn and they don't want such things. But someone who is willing to pay 800,000 for rent, they can even give you an extra month, okay? Just as security, so that in case they spoil anything, this money can be used to repair actually. So you don't have to incur repair costs of the rentals. Okay, I hope that makes sense. So with all this being calculated from the 1.4 million, you realize that at the end of the day, I also want to talk about property tax. So, like I said, property tax is a bit different from rental income tax, because whereas rental income tax, the one that we've just calculated up, is paid to URA, their property tax is actually paid to the local authorities. For example, if your rental is within KCCA, it's paid to KCCA. If it's within Chira municipality, the property tax is actually paid to Chira municipality. If you're within Kasangati, the same like that, okay? So if you're in Ibuebaja, you might pay to Kasangati Town Council or something of the sort, okay? So this is also considered. Now, it's a bit complex in how it's calculated, but a rental property of this nature and size might attract a rental income tax, a property tax of about 1 million. Okay, so to make the calculation, we'll get the 1 million, and then we'll subtract it from the 73, and also we'll get the security fees for the security guard, also deduct them from this amount. So when we get the 73 point was it 3.55 minus the 1.44 for the askari minus the property tax, okay, which is 1 million, and here we should be getting about 71.11 million. Okay, that's within the first 5 years. Then we are going to apply this very same math, 12, which will get us 97.4 million, that is per year now talking. Then we subtract the 2.82 million, which is the threshold for rental income taxation. Okay, then we multiply by how much is left after taxation, which is 0.88, like I did for you before. Okay, and here it's going to be 83.05 million. Okay, then we talk about we apply the same askari costs, and we also apply the same property taxes, that is hoping that the taxes remain the same over a 10-year period. Okay, so deducting all those, that is 83.5 years, and this times the 5 years. Okay, so this times 5, this times 5. Okay, and what we get on this side, we get about 758 million. Now I'm not going to go all the way up where we began from, but from this calculation you can see that from rent or from rental property, someone gets 750 million, that is at the end of 10 years. Okay, and then from bonds, someone gets about 800, about that was 882. Okay, 882 million. Okay, so from simple math, this one is basically has benefited more. Yeah, the person who has invested in bonds has benefited more, and then the person who has invested in rentals has gotten a little less. But all in all of them have got above. They've all recovered their income. We are not going to subject this money all to inflation, because there will not be much of a difference because none of them is actually escaping inflation. What I mean by inflation is that let's say you get 100 million today, okay? Or let's just consider the rental income that everyone is getting from here, okay? So a person who is getting 10 million today and a person who gets 10 million 10 years from now, they can't be the same because the value of 10 million today can't be the same as the value of 10 million 10 years from now. To put it in a simple way is that if I have 10 million right now, I can buy a plot of land that is 30 kilometers away from Kampala. I think it can, okay? But 10 years from now, the same 10 million will not be able to get a plot 30 kilometers from Kampala because everything else is growing, okay? Things are becoming more expensive, fuel is becoming more expensive, the dollar keeps on beating our shilling, okay? So we are not going to factor in anything like inflation because it affects both parties. Now, here is where the catch is, okay? Looking at the catch is that the assessment of after 10 years, we are going to assume that everyone has actually been spending their money because it's the reason why you invest in real estate, it's the reason why you invest in rentals, and also you can have fruit of your investment, okay? So we are going to assume that you have been actually spending the money, okay? So at the end of the day, the person who has invested in rentals and the person who has invested in bonds, your bonds are done and you're left at zero. And then for rentals, of course, you're not left at zero. In comparison with this gentleman, you had more money, okay? You benefited more, actually, okay? So there's a bit of a difference there. We are going to calculate that in a few. And so for the person of rentals, you have a property that is a piece of land that has probably grown from 100 million and it's probably now at the value of, because 10 years, I mean, the place has grown really big. The town has developed and the land that was at 100 million can even shoot up to 200 million. And besides the value of the land, you have an apartment, a block of apartments, which you built for around 600 million. And now its value should be at around, let's say, of course, when you add the depreciation together with also the growth in the value of that location itself, I mean, they balance out each other. But at the end of the day, real estate will keep growing and increasing in value because remember, the useful life of the building, if it has been properly built, should be about 150 years. Okay, so after 10 years, the building has barely moved even 10% of its useful life. So the building still has a lot more years to go, which is about 2 generations. Okay, so that means you have a building that's about a worth of, let's say, 700 million. And this is something that can actually be inherited by your children over and over again. That is why this is called real estate, because it's something real over a long period of time and can actually be inherited by your children. You can still keep earning from it, whereas you've been earning about how much money per month, about probably 7 million per month or 10 million per month. You still keep grouping from your investment even after 10 years, but the bond has expired. Of course, the explanation here is that you've been spending all that money, okay? Even here, you've actually been spending all that money, okay? But of course, here you have a balance of about the 882 minus 758. If we are to do that math, let me just minus 758. That means this person, the person investing in bonds, has 124 million more. Okay. With all that being said, I think this should make sense to you as someone who is planning to invest. If you're looking at only 10 years, this should be good for you. If you're looking at for a lifetime, I think rental should be good for you. Of course, you factor in risks of having months where there are no tenants, but what we are considering is in a location like this, a location that has cost you 100 million, okay? You should not be having a lot. You should not even having a month where you have no vacancy for at least more than a month in a year. Okay, so looking at all that, anyway, you can gauge based on different arguments. In my opinion, I think real estate is real estate. It's something to build for generations more than just looking at the short term kind of thing. You know, you want to just get your money back in 10 years or 7 years. Real estate is not for you, okay? Yes. Also, of course, basing on real investment, putting your money in bonds, putting your money in rentals is really a slow way of increasing your money. It's just more secure. But if you had 600 million today and you just chose to do business, you could even get more and more billions of money out of this money. But all these are just what are considered to be a bit safer and a bit more conservative. Okay, so thank you very much, guys, for watching. I hope you've had a lot to learn, and have yourself a great day.